All right. Hi, everybody. Welcome to Control+M Presents. We're glad to have you here so we can share our Plex knowledge with you. It's hard to believe that we're starting our 4th year of putting these sessions on and sharing them out on our YouTube channel. But as you know, here at Control+M Solutions, we're really passionate about Plex education because we feel that the more you know, the stronger the community will be, and that's good for everybody. So as a reminder, when you joined, you'll be automatically muted because we are recording this session and we'll have it up on our YouTube channel a little bit later this week. So when we open the floor to questions later on in the session, make sure to unmute yourself. Today we're going to talk about one of my favorite subjects in Plex, which is costing. And it's one that we get a lot of questions about. So this will be the first in a series of presentations on the Standard Cost Activity Report. Educational sessions that'll be run by myself along with the rest of our accounting focused team members here at Control+M. We've done a lot of work helping folks out there with their Plex costing and accounting, and we've seen some common misunderstandings about costing and some very simple solutions that start with really truly understanding the basics. So let's begin. Here's our agenda for today. Over the years, in our many implementations of Plex, we've seen it generally takes at least 2 or 3 walkthroughs of the SCAR for it to make sense, and that you really can't learn it all at once. And in our optimization engagements, where we help existing clients get more out of Plex, we've seen people who don't truly understand how it all works together. They're either working off ages-old work instructions that might not have been accurate or clear in the first place. Sometimes due to staff turnover, nobody has the time to relearn it, or due to busy schedules, folks are sometimes unable to keep up with new features in costing, or they might just not have had the time to understand the bottom line impacts of some activities within Plex, like changing process routings or bombs or just some transactions in general. And the result of this is often big, frustrating swings in inventory valuation, meaning material inventory write-ups or write-downs. So our goal today is to start you on the path to truly understanding SCAR, how it works, and show you how you can use it to identify anomalies in your processes and achieve a higher level of awareness of cost to work towards profit improvement. In a way, learning SCAR is like learning a foreign language. You sort of start with hello, then maybe learn a few nouns and start to learn how to conjugate verbs when you get more advanced, but you can't learn it in a day. And it's the same thing with SCAR. So without any further ado, let's learn about SCAR. SCAR is the Standard Cost Activity Report, and it's very literally named. It takes all of the inventory related activities that happen in a given period and it reports them out into a journal entry. It's pretty simple. And we're going to start with those transactions and a tightly focused agenda and then build on that with future sessions until you're really comfortable with SCAR. First, let's start out by talking about the merits of standard costing. Plex does offer multiple costing methods. The most frequently used and the one with the most mature options is standard costing. Most people don't really understand the value of standard costs. For me, it's really all about setting a bar to measure against. In standard costing, we have an expectation of each container of goods at the same operation to have the same value. Now, some people believe that this means the costs are less accurate, and I think that might be a little bit short-sighted view. With standard costing, we can still see variations in things that impact cost, like purchase price or maybe not producing at rate in a number of different reports like OEE and PPV. If you think of standard costing as a target that helps you budget and predict financial results, it makes a little bit more sense. If we set a standard and then measure against that, we can see favorable and unfavorable variances fairly quickly. In actual costing, the unit cost for identical products can really vary greatly, so variations themselves are harder to see. There's just that much more noise. And Plex does have 2 other costing methods besides standard. Both have a flavor of actual costing, and we've done some presentations on those in the past, so we can resurrect those if there's enough interest. Jill is going to be managing the chat today, so if you have questions or comments or things you'd like to know, please throw something in the chat and she'll keep a list of everyone's questions. What we're going to focus on today is standard costing and mostly specifically SCAR. So every day as your operations personnel receive materials, make parts or items and ship them out, adjust inventory, report scrap, those transactions are stored up. The same transactions that operations use to track inventory and produce goods, to ship products, and to measure their performance all contribute to the financial journal entries made at the end of the month. SCAR takes that big old bucket of transactions and for whatever time period you run it for, applies the part cost structure to those transactions. The part cost structure is pulled from a specific cost model, date, and time. And then Plex takes all those transactions and costs and puts them into a journal entry that's driven by the definitions in your cost accounts. That journal entry gets posted once a month, but it does require some discipline in posting to maintain a book to perpetual balance, meaning that your inventory detail valuation report should always match your general ledger. Like my earlier slide mentioned, there are a number of drivers that can make SCAR successful. And we're going to start with the cost structure. This is where Plex defines by operation the expected standard cost at each step of the routing. Since we're going to be going through transactions shortly, and I'll actually show the part cost structure, we'll cover that in a few minutes. Ours is pretty simple. Different calculations are stored in cost models. You can have many cost models, but only one is used to book SCAR. And those algorithms are made up of cost types. And you can have different calculations or different algorithms in each model. There are a lot of options in the cost algorithms and types, and I think that's going to make a great future session because I think if you've been using Plex a long time, you might not realize some of the new things you can do with it. Second driver is cost accounts. This is the table that tells Plex which GL accounts to push those transactions to. For example, you might define a raw materials inventory account to be debited for received parts and credited when they're converted to WIP. There are multiple dimensions available for cost accounts too, and that'll make another great presentation for SCAR. The third driver is the actual transactions themselves, and that's what we're going to focus on today, or at least the very basic ones. I wanted to find a way to summarize how SCAR works to make it really clear. And the best example I could come up with was grocery shopping. Even though it doesn't take a week or a month to shop, well, if it does, maybe you might want to consider your shopping habits. But anyway, if you think of the things that you put into your cart as the transactions in Plex, imagine SCAR filling up its grocery cart with transactions just waiting to check out. And when you do check out, the cash register looks up the price of every item at the time that it's scanned. And it knows what the correct price is at the time of scanning by looking up that price in a database. Think of that cash register database as being the part cost structure pulling from a cost model in a given date and time. And finally, most receipts nowadays here are broken down by department. You can see in this receipt that we shopped at the bakery, the deli, and the grocery area. Just like the cost accounts drive transactions to the general ledger, this receipt drives transactions to departments. So let's start by looking at the cost structure itself so we can all agree on where the costs in SCAR come from. Cost algorithms are the definition of math behind how costs are calculated. Ours are pretty simple. The calculations are applied and they pull in information from their sources, whether it's whenever it's recalculated. So for example, if we're pulling from the routing on recalculation, the cost will actually update. For this session though, since we're focusing on transactions, we're going to keep this at a really high level and keep the more complex options for a more detailed cost model session. This slide shows the cost algorithm or where the information comes from. And in our next slide, you'll see the results of this algorithm when it's applied to a specific part. The labor and overhead are pretty clear. We'll cover those on the next page. But under purchase components and subcontract, you might have noticed two things that you may not know exist. So for example, under purchase components, you can see I have approved supplier price and then a pipe and the word receipt. What that does, having that dual source in there, means if I don't have an approved supplier price or supplier master price or supplier part price, depending on what version you're using, I can look at the last receipt. So on the subcontract line, though, you'll notice the cost algorithm and subtype is calculating using the PO type token. not the last receipt or supplier master pricing like the materials algorithm is set to. It's set this way to handle a previously documented issue that has been fixed, yet the old rumor that it doesn't work still persists. And that is that you can't allow first operation subcon items on your routings. That can be done. In order to make it work with costing, though, you need to put in this PO underscore type token. This is documented out in Plex because the first operation used to be hard coded to material, and we have had a lot of success rolling this out to our customers. This is the part that we're going to be dealing with today. So particularly take notice at my material cost, which has a standard cost of 81 cents here. And we're going to look at that when we look at the receiving and production transactions. And the numbers for crew and production rate and setup time all come from the process routing. And we pull our labor and overhead costs from the first operation, first approved work center in the routing. The formula for overhead is pretty much the same as labor, but it does not take crew size into account because that work center in an overhead perspective costs us the same to run no matter how many people are working on it. And the setup time is calculated as setup hours times the crew times that work center cost, and then the total is divided by the standard job quantity. That means we're able to assign a setup cost per piece. And there are ways to force the algorithm to calculate setup costs with other levers, and we'll get into that in a future session. Just be careful that you don't have an error in your algorithm that has every part storing the full setup time. Now you might notice that we have a bit of a problem with the setup time here on the form operation. We have 1 hour of labor, but 0 crew here. That's the type of error that can incorrectly calculate your costs as well as your labor capacity. So I'll have to work with my team to fix that up. Just keep your eyes open for that sort of thing. Now this screen actually shows the cost increase at each operation. It stands to reason that the inventory value would go up with every time we do another transaction to it. So starting with operation 10, this part is worth $103.60 at the burn operation. But by the time the part's completely finished through the form operation, it has a cost of $130.69. And Plex knows the inventory valuation by taking the inventory by operation times the quantity at that operation times the cost at that operation. So in order to make the general ledger match the inventory valuation, we have to book each one of these at every operation change. And at each routing step advancement, we add more value to the part. So you're going to see today as we advance our parts or items through the process routing, we'll see exactly the same costs in SCAR ready for posting. So now that we understand the standard cost concept of valuing parts by operation, let's see how some of these transactions play out in real life. Like I mentioned at the beginning of this session, it's important to go slowly with SCAR and build on your muscle memory of the basics. So today we're going to focus on these 5, the most basic transactions in Plex, and what happens from an accounting perspective as each one is completed. But before we do, one point of clarification. We've got a number of people on the call today who are in what we would call discrete manufacturing, or really, metal forming, making plastics, those types of things. And we've got some food and beverage people too. In discrete manufacturing, things with routings in serialized containers are called parts. But in food and beverage PCNs, those are called items. And that's really confusing for some of us because in the discrete world, items are one way to refer to supply items. So let's avoid that confusion altogether. If you're on this call and you're a food and beverage client, every time I say part, think item. And every time I say routing, think recipe. I've tried, but I've been using Plex for over 15 years now, and old habits die hard. I'll try to remember to use the right terminology, but please be patient. We're not going to be covering supply items today, but that might be a good future session because a long time ago, Plex did not handle supplies in SCAR. It's been many, many years, and I've actually still come across some clients who didn't realize they could configure Plex to handle SCAR BOM items. So we'll start with receiving, and again, we're receiving parts or items in serialized containers. Standard costing is designed to debit a purchase price variance or PPV account, which is defined at the PO type. And it does that debit at actual cost of the part or item purchased and received, pulling the cost from the PO and the quantity from the receipt record. And those two items create the journal entry for the payable record and the PPV debit. Then when SCAR is run, the inventory quantity received is credited to PPV at standard cost, and then it's debited to inventory. That's how the GL inventory account will hold only the standard cost in there, and it's going to leave all the noise behind in the PPV account. A really nice result of this is a report called PPV, which shows the difference between actual and standard cost. So let's take a peek at a real PPV report. When I ran this report, the purchase price variance report, I ran all purchased, subcontract, and supply purchases for the company, ignoring any zero PPV, meaning, hey, don't show me the records where actual and standard matched. And you can see we've got some favorable and some unfavorable variances here. Obviously, unfavorable is red. And this information can lead you to do research that'll help identify if the issue between standard and actual is maybe due to an error on a PO. Maybe you purchased things in cases, but the price got put in eaches, or vice versa. You could have an incorrect standard or some crazy market fluctuations. This particular client has some small unfavorable variances, but some fairly sizable favorable variances. And neither one of these variances is great. I mean, yes, I'd rather be under the expected material cost than over it, because that goes right to the bottom line. But it can make your financial planning side a little bit harder, and it could be masking some profitability on those parts. So back to our part, when we receive this, the actual price on our purchase order is 75 cents per pound, and we received 40,000 pounds of it, totaling $30,000. And as you can see on this screenshot here, we've credited AP, and the debit, which comes from the PO type, is our PPV account. Now, when we generate SCAR at the end of the month, we're going to credit PPV and debit inventory at the standard cost. And that's, again, how inventory gets into the general ledger at the standard value. Once the SCAR entry gets posted, we'll have $32,400 in raw material inventory, or 40,000 pounds times 81 cents at standard. The PPV report's going to show a favorable variance, and that PPV account is going to hold that favorable variance along with all the other variances in that time period. To see how the general ledger will match the inventory valuation or perpetual inventory, let's take a look at the inventory valuation screen. This is what should tie to the general ledger at the end of every month. Now, there are sometimes reasons that it doesn't, and that'll make a good session on its own. This screen allows you to select an inventory date, which will pull quantities by operation on that date and time, and the cost date that you want to see the valuation for. In the screenshot at the top, I'm asking Plex to show me all the inventory that we had on hand at midnight on April 1st, but give me the cost date of April 19th at midnight. All of these options, including the cost model, can be defined on this screen. And there are multiple ways to view this screen, both for summary and detailed information. For simplicity, I'm just showing the summary by part. So here you can see we have an inventory detail valuation that is exactly the same as a general ledger balance that we saw on the previous screen. We often get asked where the inventory classification on a part routing step comes from. The inventory types, such as raw, WIP, and finished goods, are defined at the operation level. So if you're looking at SCAR and you're seeing transactions going in and out of accounts that they probably shouldn't be, first check the operations table and then check the cost accounts screen. You might find that you have receive operations for source material accidentally set to finished goods. Or you might have a pack operation that should be finished goods and as accidentally set to work in process. We've seen this happen in a number of our clients, and when it's incorrect, the cost accounts driving them to the general ledger can lead to some unexpected results. This is because the cost accounts might drive that transaction at that step to credit accounts that were never debited, or vice versa. Cost accounts are set up by posting type and then associated to cost types, cost subtypes, and inventory types. Looking at the screen, it's pretty easy to see how having the wrong inventory type could lead to some chaos. This is the simplest method there is for setting up cost accounts, and there are some amazing options within this cost account screen that can drive different types of transactions to different GL accounts. For example, if you have scrap reason codes set up and multiple scrap accounts, say one of your scrap accounts is meant for off-fall scrap and another one is meant for damaged products, you can drive those cost transactions to different accounts by identifying within the cost accounts. And we'll cover that in a future session because costing in the third dimension is pretty cool and very powerful. So we've covered a lot of ground here since we went through the transactions. I just want to do a quick summary of the transactions for receipt. At the point of the physical receipt of goods, we immediately debit PPV, which is assigned at the PO type, and credit AP. And that's the PO cost and the quantity received. And when we generate SCAR, we're going to end up crediting PPV and debiting inventory at standard. And this helps us manage the price variance by exception. So let's move into production, a little more fun. It's a little bit more complex, but not too much. Let's just say for fun that I produced a total of 107 parts or items, but I ended up scrapping 7 of them after production because they were not up to dimensional specifications. I'm showing on this screen the scrap log and the production history so that you can see what I did. You can see at the top, I produced 107 parts, and at the bottom, I scrapped 7 of them. So first we're going to talk about the production SCAR activities and then the scrap ones. So what happens when we produce is we really do convert raw materials to work in process. So Plex is going to credit the raw material account for the quantity and cost at standard for the expected usage of the bill of material items. Then Plex is going to debit that WIP account for the value of the overhead and labor that were incurred or absorbed at this step, defined by the costs at the production operation on the cost structure. Remember, standard costing doesn't care if it took twice as long to run a specific job. It expects everything to happen at standard. So the inventory valuation takes the quantity produced times the cost at that operation, and the inventory account gets debited for that additional value in the process routing. That's how book to perpetual or general ledger to inventory valuation report stays balanced. Here's our production in SCAR after it was generated. You can see that the usage of the raw material, and I'm just going to call it underscore raw, is listed under the component part. And under there, you can see that the credit is to our raw material account for 107 times the raw material cost. And it reduced our raw inventory account value. That's because we actually made 107 parts. Even though only 100 turned out good, we still made 107. Then that amount was debited to the work in process account, that 12,300. And under the produced part, we can see the debits to the WIP accounts and credits to the absorption accounts for labor and overhead. These are the amounts right off the part cost structure, all 107 times that debit, WIP, and credit the labor and overhead accounts. So again, our inventory valuation has increased by the cost of the 107 parts in the same amount that the general ledger will increase when we post SCAR. These accounts, again, are defined in the cost accounts screen. In fact, many of our customers wanted to talk a little bit about absorption. We only have one absorption account, but many of our clients have multiple labor absorption accounts, particularly in some of the vertically integrated companies who want to see financial results by business group. For us, it's a very simple cost account mapping exercise, and it can really help you identify and clarify profitability by business segment. On the scrap side of the transaction, on the last slide, we debited WIP for the 107 pieces of inventory, and now we have to actually credit that for the value of those 7 pieces of scrap. So as you can see in this case, we've taken the same values per operation that were debited to the WIP account, and we've credited them to the WIP account to take that reduction and debited the scrap account for the same value. So you can see we're crediting 12,300 for WIP and debiting 54,300 for scrap. And once again, here's our inventory valuation for these parts or items produced through operation 10. Now, only the 100 good parts or items show up here. Why is that? Well, because the scrap parts are scrap. Once they're scrapped, they're gone. In Plex, scrap is a permanent condition. These parts or items cannot be resurrected. They're garbage and they can only be sold for scrap value, if at all. So our part cost structure had a cost of $103 per part, if you recall from the cost model slide. And we have 100 in stock, so our valuation is $10,360. Now you might notice that this screen also shows sales price, which is somewhat irrelevant in this case, as these parts are nowhere near ready to sell. They're only through their first operation. By the way, another question that we often get is how to reduce the number of decimals in costing screens. Many of our customers are frustrated by the huge number of decimals in costing, so the setting to change is shown here. Just remember, this is going to impact more than just the inventory valuation screen, so treat it with care. You might also notice on this inventory valuation screen that the decimals are not defined at all under the extended price total. That's part of the Vision Plex screen design. In our PCNs, it's set up this way so we can show people how to easily make VP changes, but in your system, you'll probably want to correct that. If you don't know how, check out our YouTube channel where Kevin Pope did a nice session on some simple VP changes. All right, the remaining production operations really work all the same, but of course we'll throw in a few complications to make things interesting here. At the second operation, we're going to allow some over depletion. What is over depletion? Well, generally you wouldn't see it at the second operation unless someone miscounted at the first. Generally, you'd see it on a raw material operation, but in short, it's using more than what Plex thinks you have. Example, if you stamp parts out of steel and you buy a 1,000-pound coil of steel, it's really consumed in length, and that length can vary based on gauge. It's also pretty likely there'll be some weight variation in the coal, so sometimes you can overuse your source material, and Plex will automatically create an adjustment record. So in this case, we're going to move 101 pieces from operation 10 to operation 20 and automatically adjust that one piece in at operation 10 so that we can consume it out of 20. The setup for this is fairly simple. It's called over depletion. It's in the operation type table. So comment if you'd like to learn a little bit more about this. We can talk about over depletion and rollover adjustments because for some of you on this call, it really does make a lot of sense to use them. So let's look at the SCAR activities based on producing 101 items out of only 100 items. So when I reported the 101 pieces at operation 20, we credited and debited work in process. This is because both operation 10 and operation 20 are set up as an inventory type of WIP or work in process. We technically could have different WIP accounts to drive them to, but for simplicity, we only have one. And you'll notice that the entry was made for 101 pieces, even though I only put 100 in when there was operation 10. That's okay. We're going to see where that extra piece goes in there on the next slide. Now, SCAR is sort of a chatty program, but it debits and credits the same accounts for these amounts to make it much easier to see what's happening at every step. So remember, we only put 100 parts or items into work in process at the burn operation, but we took 101 out. So Plex has to put that one part into operation 10 in order to keep things in balance. So here's the adjustment that Plex made when I over depleted using a rollover adjustment. Now, when we talked about cost accounts earlier, one of the cool things you can do with them is drive things like adjustments to different general ledger account. In this case, we're just running everything to the same adjustment account. And here's our inventory valuation after operation 20, and it's showing 101 pieces because that's what's in inventory. And you'll see in here the extended price now has 1 decimal point. And again, that's because it's how it's configured in the VP screen. For us, it's by intention as a teaching mechanism, but if it were my business, that would make my OCD go wild and I would have to fix it. And I see Jill put in the chat program the simple Vision Plex changes. Thanks, Jill. When you send parts or items out to a subcontractor for outside processing, like heat treating or plating, nothing really changes on that container except the location. The operation stays the same, and the quantity stays the same. So there's really nothing for SCAR to do. But when the parts come back, this is treated like any other material receipt with a debit to PPV and a credit to AP on the receipt. And if the cost types are set up correctly, then the subcontract values will show up on the PPV report like all your other inventory purchases. Once we receive the items back from the subcontractor, then the SCAR posts very similarly to how it would if the parts were internally processed by adding value of the subcontract work to the WIP account and offsetting that PPV account for the cost of the subcontracting at standard. And it moves all the other costs from WIP to WIP, just like the past screen. Like I said, it might seem chatty, but it does make it really easy to see what's happening if you understand how the transactions work. And here's our inventory valuation for the parts or items after they're through the subcontract operation and back in our facilities. And it will, once again, it should match your general ledger once the SCAR is posted. Finally, producing this at the last operation in the routing form is just like all the other production transactions. But in this case, since that operation is defined as a finished goods inventory type, we're going to credit WIP and debit finished goods here. We're going to move those 101 pieces from heat treat, which is a work in process operation, to form, which is finished goods. Note this does not happen just because it's the last step in the routing and it's not related to the shippable flag. It's because of the inventory type set at the operation. Then we're going to add the labor and overhead costs to that finished goods account as well to absorb overhead and labor. Now, the account number and inventory type changes are really the only differences between this and the previous screens for production reporting. But it's a great illustrator to show how having your inventory types or your cost mapping incorrect can lead to some chaos. We've still got 101 pieces now fully moved from WIP to finished goods and fully absorbed. So let's check out our inventory valuation. Here's our 101 pieces in valuation, finished goods account, and fully valued. And you can see that they're costed well below the sales price, which is good. And that's a little bit more meaningful now that we know these parts are completed. Let's look at what happens when we ship goods out. When we do ship goods out, Plex is going to immediately create the customer invoices for you and book the revenue and accounts receivable. It'll also change the container status to shipped, and the ship container status will fall off your inventory reports. The container still exists, it's just not included in valuation. But what the shipment doesn't do is reduce the inventory general ledger account. That hasn't changed yet. SCAR is going to do that for you. It's going to go back and book the cost of goods sold and then relieve that inventory account for us. On the posting of SCAR, the inventory general ledger account will be relieved and the cost of goods sold, or COGS, will be booked to the accounts defined in the cost account screen. Now, in our COGS or our PCM, we only have one COGS account, but some of our clients have COGS for material, labor, and overhead, and some even more complex, they can have COGS by part definition, and within that definition have material, labor, and overhead. Since we're going to be doing a session on cost accounts and how to set them up, we might, if there's enough interest, we'll break that out to say we can help you break out sort of a gross profit analysis by part group if you can't. So time for you to get comfortable doing some testing in your PCN. In order to build that muscle memory, you're going to want to do these transactions in your test database and then run SCAR to see how each one looks. You want to check the cost account screen if you're at all confused about the accounts getting credited or debited. And make sure that you're in test because we don't want a bunch of fake data in your system. Also, you can run the SCAR for today's transactions in test. It'll run in live as well, just can't rebuild it here. I like to make my own part using existing suppliers and work centers so that I can filter my transactions a little bit more easily. Did you notice that my parts today all started with CMP STD? That's so that I can look at my control and present standard costing parts very easily. I can filter those pretty easily. And keep doing these transactions until they're comfortable with them. Just remember to recalculate the cost model for your part before you start. In case you're not familiar with generating SCAR, this is what the screen looks like. You're going to click the generate button and select the cost model and the cost model date that you want to use. Then use the date range for your transactions, which since you'll be running it in test, it'll be today. I like to choose tomorrow as my cost model date so that I know Plex is grabbing the most up-to-date one. If you think of it this way, let's say I have multiple tabs open in Plex or multiple screens if you're in Classic. If I'm in there playing them on with recalcs and my cost model date is, let's say I started on April 19th at noon. If I'm working on it still at 3 o'clock and I don't remember to change that date till tomorrow, I might miss some of the costing pickups. Remember, if you're using a new part, a test part, remember that you'll have to recalc that part to get initial costs in your operations. If your part's not showing up, make sure the standard flag is on that operation. But whatever you do, do not recalc your cost models in live without consulting your accounting, costing, and engineering teams. You can cause all sorts of financial chaos doing that. The people who close your books will not appreciate it. So even if the model that you want to recalculate is not set to the primary, please consult your teams before recalculating. And never delete a cost model, because remember, in Plex, deleting is permanent. It's rarely a good idea to delete anything in Plex, which is one of the reasons that we really trim back the ability to do deletes anywhere in Plex, except for things like shippers. Now, if you don't see the generate button, contact your system administrator or maybe ask your cost accounting team to generate it for you. Once generated, you can click search to see the details if you want for the parts or items and supplies to look for your detailed transactions. These are the little buttons above the search here on the right. Filters like inventory type and posting type are helpful when you're searching for the result of your transactions. We've covered the basic transactions pretty well, but that doesn't cover them all by any means. In fact, two of the most challenging transactions are rework and optional operations. And both can cause some real chaos if they're not handled particularly well, especially if you have high value parts or items. This can really create some excitement in the balance sheet. Other transactions we're going to cover include returns, customer returns and supplier returns, as well as the production correction button, the OOPS button. Now, if you've been using Plex for a long time, you might not be familiar with that button. If you're not, check out our session called Proper Unwinding of Transactions in Plex on our YouTube channel. That button is really amazing. It's terrific if, let's say, someone was supposed to report 100 pieces and they reported 110. You can unreport and re-report. Now, I will be honest with you, there are some struggles with it, but the button is really a heck of a lot easier than doing those transactions manually. And now let's talk about the next steps for our continuing SCAR curriculum. Like I mentioned at the beginning of this session, SCAR isn't something that you pick up in a hurry. It takes time to configure, design, and test. And when it's done correctly, you can really clarify issues within your business. So here are some of the topics that we're going to be bringing up in our future session. And if you have more topics you'd like to suggest, I'd like to ask you to put them into the chat for us to consider when we're scheduling. So driving cost accounts, and this will be cost account in multiple dimensions. Advanced cost algorithms, we'll also talk about fixed costs, supply item configurations, as well as some of the options that can get you closer to different LIFO, FIFO methods, etc. We're going to go through the suggested month-end closing. If we get one call frequently, it's why is my material out of whack and why is my inventory count out of whack and how can I get that not to have those big write-ups and write-downs every month? We get that all the time. How to post SCAR for mid-month financials, and the big one is typically troubleshooting manufacturing variance, which is really the recording, the difference between what we expected to use and what we did use for a bill of materials. Now I'm going to open up the floor to questions, and while I do, I'm going to share the slide that talks about our next upcoming presentations. Make sure that if you have any questions, take yourself off of mute. So let's open up the floor to questions.
Do you get selling price on the cost structure and inventory valuation?
Oh, any other
I think
questions?
that's all you have in the chat.
Thank you. All right, well, if you do jump in, I want to thank everyone so much for the gift of your time today. We've been keeping our fingers on the pulse of the Plex community, and we know that you want to see more content. I'm sorry our team got really tied up this spring on a really large training activity, but we're back at it, and we've got our next 3 sessions already planned. In 2 weeks, Jen Berry's going to be doing a session on multiple customer pricing methods, as well as how to do price adjustments, price components, and additions like charges and services. And after that, Veronica's going to host another popular EDI roundtable, which is basically an open forum for questions and comments about EDI. We do have an EDI basics video on our YouTube channel if you'd like to watch that. She'd really appreciate it if you'd send your questions in advance. Her email's on here. Just please put CMP EDI roundtable questions in your subject there. After Veronica, we're going to get back to SCAR. Hopefully May 31st will be a good time for folks. I would imagine if you're on a calendar month closing period, that should work well. If you're on a 445 or a 454, that might be a little bit more challenging, but do remember that our recordings are always on our YouTube channel for your consumption at any time. Speaking of that, if you do enjoy them, please go out and subscribe, click like on our videos. Like everybody else, we like to get a pat on the back every now and then. Thanks everyone so much. Appreciate your time.
Patty, are you still there?
I'm still here.
We have more questions in the chat if you wouldn't mind hopping on.
Do? Wait, okay, now I'm seeing them. Thank you.
Okay.
Oh,
Yep.
Robert, thank you. Showing selling price detail and cost structure is a setting. Filter on the setting, selling price detail. It's called filter for a setting called selling price detail. Okay, JMac, your question. If you have an operation that can be both WIP and finished goods, do you create 2 ops? I absolutely do, Jen. And a lot of times we see that when we have customers who buy stuff and resell it or buy stuff and make it. So let's say, for example, you're a company that makes bolts, but you buy nuts. So you might buy bar stock as a receive operation that has an inventory type of raw material, and you might buy nuts that has, maybe a buy sell buy sell operation that has an inventory type of finished goods. Have a good day, everybody. Take care. Thanks, Jill. For some reason, I had the chat filtered to only